me to wrap things up because I could talk for 5 hours straight and I lose track of time. So just let me know. Just give me some sort of signal. I'll wrap it up quick. I always prepare more than I need. Okay. Hi, I'm Mike from Stony Brook College of Business. I primarily work in the Department of Finance, and my specialty is investments. I guess I woke up to investments in 1987 with the Black Monday crash, and that really kind of piqued my interest. And I said to my dad, can I have some money? I want to invest in the stock market. And he said, absolutely not. We lost our family fortune in the 1929 crash. We were a very rich family, owned a network of furniture stores in Manhattan in the boroughs. And my grandfather invested heavily in the market on margin. Market crash, we lost everything. All the furniture stores, all of the stocks. And so my father was very much against investing in stocks at all. So once I heard that, I was even more interested in investing. So I got a job and started working part-time and started putting my money in the market. And then was a real student of the 90s of the stock market. I was getting my MBA in finance, and I was playing the market. And for the first 5 years or so, I lost money every year. And it was the greatest learning experience. In fact, I would say that I learned more losing money than if I would have spent that money on a course. So I kind of looked at it that way. And it was really trial by error. I made all the common mistakes in the beginning, and I started reading a few books. A key book was Peter Lynch's. If you're a little bit older, you remember Peter Lynch was the #1, probably still #1 mutual fund manager of all times, running Fidelity's Magellan very successfully. He wrote a book, went up on Wall Street. So I read a series of books and just kept involved in the market. And it's always been a passion of mine, and was a big student of the 2000 crash. Learned a lot there. Was able to, before the crash in 2008, 2007, luckily I was able to time the market very successfully on that. Got out in 2007, back in 2009. I don't recommend timing the market. I just happen to luck out more than I should in that particular market. So we come to another precipice where we get this 8-year wonderful stock market returning over 300% to investors. Just absolutely fantastic. So a lot of people want to know what caused this. Why did we have one of the longest bull markets on record? And particularly, why did the stock market go up so much in 2017? And so if we look at some of the analysts, they're projecting the market next year, 2018, to go up at least 8%. So we'll probably finish this year somewhere between 20 to 25% increase in the market. When I say the market, I'm primarily just talking about the S&P 500. And next year, they're looking at another 8% gain, which is good news for everybody. So the target for the S&P 500 would be about 27, which is 7.6% above the closing price of a few weeks ago, 25.50. And overall, there are about 11,000 ratings on stocks from professional analysts worked at many financial companies. And of these ratings, 49% are, 49% are buys, 45% are holds, and 5% are sells. Now, don't be too encouraged by that statistic. That was a similar statistic in 1999, end of 1999, where most of the analysts had buy recommendations on stocks, and then 60 days later, all the stocks were down about 30%. So, but right now, it's still kind of encouraging. So some of the main drivers that are really propelling the stock market to all new highs, and we hear this every day, new highs reached on the market. So if you watch any news program, they usually start off in the financial section. They talk about, again, new highs are reached. And some days we have a triple new high of the NASDAQ, the S&P, and the Dow, which is amazing. But why is this happening? One big thing I'm going to talk about, there are fewer stocks to buy. And I'll detail how many fewer stocks. Profits are a big driver. Profits have been great this year. Tax reform, which is big in the news right now. The gradual pace of the monetary policy tightening, and the synchronized global recovery. So those are the main drivers that represent the big increases for 2017. So when we talk about fewer stocks to buy, in 1997 was sort of the peak of stocks to buy. So we had over 6,000 stocks, and this data is from the CRISP database, one of the new databases our College of Business has. So in 97, we had over 6,000 stocks that you could buy. And today, due to mergers and acquisitions, going private, capital investment groups taking companies private, it's down to just over 3,000 stocks. So we have a smaller supply of stocks to invest in. And that's, of course, we have a growing amount of money going into stocks, because through mostly the funneling of the 401ks, plus the institutional investors, a lot more money is going into fewer stocks. So that's supply and demand. Economics is going to raise the prices. Pretty common sense. So this is just a graph of the number of stocks. You see how we peaked, and again, this is from the CRISP data base. We peaked in '96, and this is during the dot-com boom, where a lot of it was easy to have IPOs. So the IPOs were fueling additional stocks. The merger activity wasn't as great. And then when we come to today, we have a real, we haven't been this few stocks since back in the 80s available to purchase. Now the good news for everybody is that profits are up. So companies are making money. In fact, the S&P earnings, and that's the earnings of all the companies in the S&P sort of on average, are up 10% in the second quarter. And it's the first time between the first and second quarter that 2 quarters of double-digit growth in profits since 2011. Investors buy stocks based on profits and profit growth. Now, the third quarter is expected to drop into single digits due to some hurricanes and other couple of minor economic changes. But the fourth quarter of this year is expected to be double digits again, with almost 6% revenue growth. And for all of 2017, we're expecting about 9% growth in earnings and close to 6% growth in revenue. So it's a very prosperous time for these companies, and that's what supports stock prices. So if investors, institutional investors especially, the mutual fund managers and the hedge fund managers, if they see that, okay, the fundamentals are getting better, the profits are going up, the revenues are going up, this supports the valuations. So valuations haven't gotten out of control because companies have been doing very well. Okay. And then profits are expected to go up through 2018. Now there's a lot of information in these slides. If you're interested in getting these slides, you could email me. I could give you a copy of these slides, or we'll figure out some way. I'm also recording this lecture because there was a number of alumni that contacted me that they couldn't be here today. So I figured I'd record what I'm saying, and I'll help some of those alumni get the message out. But for 2018 and the end of 2017 and into 2018, we're still projecting increase of profits and increase of revenues, double digits. And if we have, we might have another double-digit growth in end of 2017, beginning of 2018. Now, another big factor is stock dividends. So stock dividends are up. Let me just go to the slide. These are the dividends from all the way back to 1999, which was the last, sort of the end of the 2 bubbles ago. So from 1999, you can see the dip in 2007 to 2008, because when the economy contracts, the first thing businesses do is try to preserve their capital. So what they do is they pull back, reduce their dividends, reduce their stock buybacks. So we see that quite clearly in the Great Recession. But since then, we've hit all new highs on dividend payouts. So the S&P 500 has been very generous with dividends. Now, because the interest rates are so low, and many retirees or investors are looking for income as well as capital gains, some of these stocks are paying 3%, 4%, 5% return on dividend. So it's a great place to park your money. So your money is growing because the stock is growing, and you're also getting income. So that also makes stocks very attractive, especially when bank accounts are at such low rates of return, which are, in my view, basically zero. And you see your bank statements like, oh, I earned $5 of interest on $100,000 of savings. Now, stock buybacks are another big factor. So what is a stock buyback? Well, companies, the idea originally of a stock buyback is if your stock is undervalued, you should buy it back. It's a good opportunity to put that stock into your treasury stock and get it while the valuation is very low. Somewhere in, I think I have a chart on this. In the 1990s, companies learned, hey, it doesn't matter. We don't have to wait for a low stock price. We could buy when the stock price is high, because investors like to hear about a stock buyback. It encourages them to buy our stock more, and it reduces our outstanding shares, which makes all our per share variables, earnings per share, revenue per share, anything that's a per share value goes up because we're reducing the amount of outstanding shares. And we're putting more demand on the stock from us buying it, so it helps the stock price go up, which keeps our investors happy. So stock buybacks are almost expected from a lot of companies these days. And you can see, again, when there's a big recession, the stock buybacks dry up because companies are worried about their money and their capital, and banks aren't lending. So once right now lending is so generous at such low interest rates, money is practically being given away for free. And we could see this in Manhattan. You go into Manhattan, I've never seen so many cranes working on so many condominiums in Manhattan. Why? Because real estate developers know money is very inexpensive. There are people who want to pay $2 to $6 million for these apartments, these condos in Manhattan. It's a no-brainer. Throw these buildings up and make these residential complexes in Manhattan, especially if you look at Hudson Yards. They're going to cover the train station. They have several projects going up in there. It's amazing, as well as additional commercial space. So getting back to stock buybacks, on the buyback side, you could see that we hit some peaks in 2007, and again, we're going back to some of those peaks, although we're pulled back a little bit, but still, we're giving a tremendous amount, almost $600 billion in stock buybacks. Now, the thing that worries me about stock buybacks is if companies are buying at the peak or the top of their stock, when the stocks do go down, it's sort of a loss for them. They're burning through money. So I like companies like Disney that go in and buy Lucasfilms or Marvel Studios, $4 billion for Lucasfilms, $4 billion for Marvel Studios. Now they want to buy Fox's TV and movie production, probably from anywhere from 4 to 8, maybe 10 billion. That to me makes more sense than throwing 4 to 8, 10 billion into the stock market to buy back the stock, because that's planning for longer term growth and building the company out. But a lot of managers and financial managers and presidents of companies are running on the short term. And the stock buybacks and dividend increases are a good short-term way to keep your shareholders happy, which keeps your board happy, which keeps your job stable. Okay, so if we look at the stock buybacks, Apple has bought back $7 billion worth of stock in the first quarter alone, and $34 billion of their stock in the last trailing 12-month period. And overall, they spent $150 billion buying back their stock in the last 5 years. And keep in mind, their valuation is $900 billion. So you can see it's almost 10% of their valuation that they've bought back. So that's a huge amount of investment in Apple. Pfizer spent the second largest. They spent $42 billion over the past 5 years and $57 billion over the past decade. CVS has spent a lot of money. Johnson & Johnson, just billions. And then we have Boeing, Bank of America, Walmart, all spending multiple billions, tens of billions of dollars buying back their stock. So if we look at this graph, we see that if you add the green line is dividends, on top of that are the stock buybacks, we get to close to $1 trillion of dividends and stock buybacks in the marketplace. And these are courtesy of Standard & Poor's. So all these slides are professionally made by Standard & Poor's. They're not my ability to make a slide this great. So we look at, the red line is the S&P 500 index. So you see, there's when you get a spread between the dividends and buybacks compared to the market growth, that could be a little worrying because it's starting to outtrend even the money being reinvested into the companies and paid back to investors. And you can see how the Great Recession, there was a dip, and we also had a dip in 2001 because that was a very prolonged and nasty stock market decline from 2000 to 2003. And you can see how that, the stock market reacts. But you can see it follows right through with the stock buybacks and dividends. All this money going into the market is encouraging the stock prices to go up and encouraging, now everybody is hearing about stocks and want to talk stocks. And it's sort of, Peter Lynch has this cocktail effect. And when he used to say, if he went to a cocktail party or a networking gathering and nobody wanted to talk to him about stocks because stocks were down and people didn't want to be reminded of their misery, he knew it was the time to buy. And if he went to a cocktail party or a networking event and everybody wanted to talk to him about stocks, then that was the time to sell. So when it starts to get to the everyday person wants to talk about stocks, wants to be invested in stocks, it starts to represent a peak in Peter Lynch's mind as well. So we're going to go through some of the other reasons. I feel that the stock buybacks and the dividends are two of the biggest reasons, and the reduction of outstanding companies to purchase. But if we look at tax reform, oh wait, let's go back. If we look at tax reform, we got the new release of tax reform. Today, I think the Senate's going to release their plan for tax reform, and this is what a lot of, they say that the market is built in some of the expectations of this passing, that companies will be more profitable after the tax cut. So people are worried if it doesn't make it through, if it gets, doesn't become law, that may have an effect to pull back the stock market, as these expectations are already built in. Now, the gradual pace of the monetary tightening, we know there's a new, Trump just is going to appoint a new Fed chairman, and he is looking to be similar to Yellen, dovish, on board with the very slow pace of monetary tightening, where they're going to raise interest rates at a very slow and steady pace and tighten on the quantitative easing. So the quantitative easing has ended, and they're starting to reverse it. And all the quantitative easing was them buying bonds to drive down the price of the yields on the bonds to encourage lower interest rates. So when they unwind that position, it could put some pressure on interest rates going up, because there's an inverse relationship between price and interest rates. We have this wonderful synchronized global economy. You know, Germany's up 20% in their stock market. South Korea's up 20% in their stock market, even with this North Korean crisis. So the world markets in general, they're up a lot too, because their economies are making profits, are producing sales growth. So we have this very rare event where this synchronized global recovery, where most of the top economies are increasing and improving. So that's putting more confidence into the market, because if other countries and other economies improve, we sell a lot of products to them. And that helps our companies to improve and grow. We're still in this low interest rate, low inflation environment. What does this mean? When we have low companies, even though they're making a tremendous amount of profits, they've been slow to share that with employees. So overall wage growth is very suppressed. And at this point, with a 4% unemployment rate, or 4.1% unemployment rate, you would expect to see more wage growth. But that's being suppressed because companies have found a new strategy or a new ability to reduce the amount of increases to employees, where the average increase to employees is somewhere between 0 and 2%. And that's through that low wage growth enables the Fed to have lower interest rates for longer periods of time, because wage growth is one of the major factors for sparking inflation, or one of the things they look at. So this lower wage growth is keeping this low interest rate, low inflation environment alive, which means for a lot of companies, capital is almost free. If they have good credit ratings and they're a large enough company, they can get a huge sum of capital for very low cost. And that's why a lot of companies are borrowing money to buy back stock or pay dividends. And that's a dangerous scenario. If you're borrowing billions of dollars to buy back stock and then the stock price goes down, you're still on the hook for that whole loan. So it could be, you know, a dangerous, scary scenario. We have this herd mentality, and the Peter Lynch cocktail method I talked about before. The herd mentality is we keep getting reinforced that the stock market's going up. You don't want to miss this. You don't want to miss the hockey stick. That's when we get that big jump in stock prices. So a lot of people, they fear that there could be a correction or a crash. But right now, they fear being out of the market more. They don't want to miss. If you miss a 20% gain this year and a 20% gain next year, even though if the market does go down, you're still doing better by being in the market. Even if there's a 10 or 20% correction, you're still ahead of the game. So people are fearing missing the gains. Now, if we look at valuation, to get a little bit more technical in the finance world, valuation, oftentimes we want to measure it by PE multiple. And that's price to earnings multiple, the amount of time the stock is trading by its earnings. So its earnings is $5 and the stock trades at $50, it's a PE of 10. If it trades at $100, the PE would be 20. So it's a multiple of the earnings. So right now we have a multiple of forward 12-month PE of about 18. The average in the last 5 years was 15, and the 10-year average is 14. And that's, so we're a little bit on the high side, but not crazy side of the forward PE. So it's the first time we hit this 18 mark on the S&P 500 in 15 years. Now, that's still considered relatively, I would say, fairly valued. I wouldn't consider that very overvalued because we've had PEs much higher in the S&P 500, especially in 2000. I wouldn't consider it undervalued either. So somewhere around a proper valuation. Okay, that's just some other details there. So if we look at the trailing PE, and that's looking at earnings, so the forward PE is looking at future earnings, the trailing PE is looking at past earnings, we could see that the trailing PE is higher, it's at 22. We see that big peak there, and that's more around the 2007. The dates in the bottom aren't, they're a little squeezed, so not accurate with the chart. But we did have a peak of 24 before the last big crash of stock prices and PE multiples, and now we have another peak about 22. So that is a little troubling. We're getting to a high end of the trailing. But the thing that I'm not so worried about the trailing is because the future profits still look better. And as long as those come to fruition, that's going to keep down the valuation and keep the stock market growing, which is what we all want. RSI, Relative Strength Index, is a technical measure. So when we look at RSI, it's really looking about the amount of money going into the stock market on the days the stock market increases versus the amount of money coming out on the days the stock market goes down. So it's a measure of interest or strength signal of the market. And typically it runs from zero, it always runs from 0 to 100. Over 70 is an overbought market. Under 20 or 30 is an oversold market. So if we look at the RSI is actually the top chart. The bottom chart is the S&P 500 growth. So you can see the big growth from 2016 into 2017 went from about 1,800 up to 2,500. But the RSI now is peaking above 70. So the RSI is saying the market's a little over purchased, and then when it is over purchased like this, there could be a 5 to 10% correction, which doesn't mean the bull market ends. It means it's a pause, things correct, people realign, and the stock market can take off from there. So corrections are actually healthy. It's the crashes we don't want. We don't want these 20% declines in stock prices. But a 5 to 10% decline is actually considered healthy to readjust the market. So this RSI indicator is a little bit high. And the thing that I look at the most when I look at stocks is stock price growth versus earnings growth. Because I am a firm believer that the reason stock prices go up is because the companies are doing better and earnings are going up. And that's how you're rewarded as a company. So if you're a company and you can make more profits and growth, but specifically growth in your profits, you should be rewarded with a higher stock price because your earnings per share are going to be higher. Investors are going to want to move in. Now, in this particular chart, we see that in the light blue line, that's the stock prices. And as you can see from the left-handed scale. On the right-handed scale, we're looking at earnings per share in aggregate for the S&P 500. Now, we could see that over 2013, earnings started to outpace, stock price started to outpace earnings. So the dark blue is earnings. And today, we have the biggest spread between 140, earnings are at 140, and you can see that the forward 12-month earnings is at 180. So we have a big spread between the trailing and the forward. This is the stock price is sort of gaining momentum above the growth in earnings. So earnings are growing slower than stock prices. Stock prices are growing much faster than earnings. And that could be worrying because you don't want too big of a spread between the growth of earnings and the growth of stock price. They should be somewhat parallel. So if earnings go up 10%, it's okay for the stock market to go up 10%. A lot of times we have this PEG ratio where we look at growth in earnings should be relative to the growth in the stock market. So we're seeing an acceleration in the growth of stock prices versus the growth of earnings. Okay. Now, a very famous economics professor from Yale, he developed the CAPE, which is an adjusted PE model, which is adjusting for inflation and other factors to smooth out some of these bumps. So this particular model is looked at trying to make the earnings a little bit more stable, a little bit smoothed out from some of the inconsistencies in time like inflation. So if you're comparing the equities from inflation-adjusted earnings over 10 years, if we look at from 1929 to 2000, we haven't seen a level since these two peaks. So, this ratio is another PE ratio, but it's a little bit more finesse to give a more accurate picture, and we're over 31, which puts us at the same level as the peak in 1929. But it's not, we did peak higher in 2000. In 2000, we went over 40. And in 2000, we're a very unique environment where people are smart enough now. In 1999, we believe that it's a new paradigm. Stock markets are not going to crash. We can have these valuations at this height due to the internet and the productivity, and we just believe the hype that stocks were not going to go down. And that really accelerated the bubble of 2000. And then when that bubble came crashing down, it was very hard on stock prices and people's accounts. But right now, we're reaching a peak that surpasses 2007 and matches or surpasses 1929. So we are in a potential bubble territory. Now that doesn't mean just because we're in a bubble, we could enjoy the ride. It could last another 2 to 3 years of 10 to 20% stock growth, and you don't really want to miss that. However, at any moment, like an earthquake, a stock crash could happen. And when it happens, like an earthquake, people panic, people get scared, they make bad decisions. And that's what we have to worry about. Okay, so that's some of the problems ahead. So if we look at some of the problems ahead, people are worried about the strength continuing. We're worried about this stock market bubble. We also have a bubble in the bond market. And one of the best bubbles I could point to right now is the cryptocurrency bubble in Bitcoin, over 6,000, maybe it's over 7,000 today. Who knows? It's insane. Why is it going up so much? It's an artificial currency. What's driving it? It's just supply and demand. Real estate market's in the bubble again too, people are saying. If you notice, the house valuations have gone up quite nicely over the last 12 months. So maybe not so much here in Suffolk County, more in Nassau County, and definitely in New York City. And what is the most expensive city to live in North America, real estate-wise? Vancouver. Vancouver, and then you got your San Francisco, your New York, your Toronto, but Canada didn't get the real estate correction we did. So Vancouver is inundated with a lot of Asian money coming in and buying properties, driving up prices. And also Toronto. So a typical house on Long Island, say, is a $400,000 high ranch on Long Island. That same size house in Toronto would be $1 million Canadian dollars, which aren't too far off from American dollars. But their market's really exposed. So I was surprised to see that Vancouver was top of the real estate bubble right now. Okay. So stocks are heading into the earnings season. Right now, this earnings season is looking better than we expected. So this is great. Another reason stock prices have gone up. We were worried about that. We were worried about the new Fed chief being too aggressive in accommodation. Doesn't look like that's going to happen either. Companies have cash, but they are spending it on stock buybacks. That is worrying. We want companies to have more of the capital going into improving and growing in their company and improving profits. And one of the problems is that economy is cyclical. We don't stay in a growth model forever. There's always a pullback, and that affects the stock market greatly. And with everybody just sort of piling their money into index funds, so remember I had that pool of over 3,000 stocks? If you look at the index funds, that pool of stocks is even smaller. And most people through these 401ks, where a lot of the market money is coming from, greater than 50% of the money invested is from these 401k contributions, they're all going into index funds or similar types of mutual funds that are investing in index stocks. So there's even smaller pools. So if you look at these indexes, they are outstripping and growing faster than the stocks that are not part of the indexes. So that's sort of worrying, because when investors get scared, they tend to pull their money out at the worst point, exacerbating the lows of the market. How are we doing on time? We're good? Okay. So low unemployment. We have this low unemployment. However, it's a little tricky. If you look into low unemployment, we've actually lost a lot of very good, high-paying, high-benefit jobs. In many cases, a full-time job will be lost, replaced by 2 part-time jobs. And that counts as job growth. Even though it's the same hours worked and there's less pay going to these 2 people working part-time, it's included in job growth. So when you see this low unemployment rate, you have to factor in there's a lower participation rate, and there's many people who've just given up looking for jobs. So there still is a lot of people who could get good jobs or want to upgrade their jobs. But right now, there's been a destruction of overall very good jobs and more lower paid jobs. So you look at the jobs reports, they're coming in and lower paid positions lead the job growth, not higher paid positions. And that's hard for the economy because we want the high wages to drive the economy. But employers want more lower wage employees to drive their profits. And this, so inflation has been helped by this new jobs creations, because workers who also have good jobs are not getting very generous raises. So we have a new culture that was, because of low inflation rate, they've been producing lower wages, increases in wages.
That being said, if there are fewer high-paying jobs, more low-paying jobs, more people outside the market, where how are companies making, where's the money coming?
There's still a lot of consumers buying on credit. And there's still a lot of people who have good jobs. And when they feel confident in the economy and the stock market's doing well and they see their 401k going up, they buy more. And they buy more on credit. So drivers of the economy, defense, healthcare, some of these things are, going to increase whether or not, despite what people feel, because if you need health care, you're going to get it. You're not going to say, oh, well, I don't feel so secure in my job. You're going to get your health. You know what I'm saying? So what's really propelling the economy may not be, more people are working, and as aggregate, more money is being made. It's just not as a nice portfolio of jobs as has been in the past. So millions of new jobs have been created, and a lot of people have been lifted out of unemployment. That does help. But what helps employers' profits is that they're not bringing in more higher-waged employees. They can hire college students. They can hire older workers coming back into the workforce who may have thought they were going to retire at 55 or 62, are now working to 72, 75, and are willing to accept lower wages than their peak. So this helps companies make more profits, and as far as, there's not a worry about not enough people to buy things. Consumer credit has gone up tremendously, especially we're talking about auto loans earlier. That has been a huge increase in the amount of money lent for auto loans. It's one of the bubble areas of lending, as well as student loan debt. So money is being cranked out there on credit, helping to make up the gap between wage growth and that's and remember, the economy is still in the low growth phase. We haven't really we've got to 3%, but mostly our growth in the economy has been 2%. So our economy really hasn't grown that much. But companies have been very good at squeezing more profits out of the company. So even though the economy is growing at 2 or 3%, they're growing their profits double digits and their revenues. So companies are just becoming more efficient, more productive. And if we look at, this is the federal funds rate. In the lighter area are recessions. So you see the blue line, as the Fed raises rates, it's always commonly followed by a recession. So we see in 1990, we had a recession after the Fed raised interest rates. 1980s interest rates, we can't even talk about. They're just an anomaly. Paul Volcker and inflation, stagflation, all this craziness in the 80s and 70s. But in 1990, 2000, 2007, when we get the peak of the increases of these interest rates, typically the economic cycle goes into contraction. So this is worrying that we're in an expanding cycle, and we have that phrase, don't fight the Fed. So that means, don't expect the stock market to do great things when the Fed is tightening. So that's a worry. So are we in a bubble? Most people, think we're in a bubble. But we're smarter about these bubbles than we're in the past. No one's going to be caught by surprise when this bubble deflates. As long as the central banks are cranking money into the economy at these low interest rates, it's going to help fuel this bubble. So a lot of people say, should the Fed think about popping this bubble or letting the air out slowly? And should we be worried about, a debt crisis in China, a war breaking out in the Korean Peninsula. These are things that, yeah, we have to worry about, and the market will react, but these are short-term things. And if you're invested long-term in the market, it's nice to talk about and think about these short-term bubbles and changes in stock prices, but long-term, you could always ride out, if you have enough time, any of these unusual price discrepancies in the market. Okay, so let me just get to, I just want to give I'll take questions, just give me 2 more minutes and then I'll answer your questions. All right, so these are just some of the highlights of the presentation. These are the declines in the stock market crashes. In 2007, we have a 60% decline that took 17 months. On average, bear markets are about 32% declines for 15 months. 73 was a bad market. 2000 was a 50% decline over 30 months. That's why it was so grueling. That was a 3-year decline. Okay. Okay, so I'm just skipping to the end. Right now, just to sum it up, people are fearing not being in the market, missing these gains more than a potential crash in the market. So that's why a lot of money has stayed in and very few people have took their money out, because you don't want to be the one missing the 20% gains. And this market could be in an expanding stage for anywhere from 1 to 3 more additional years, maybe even 5 more additional years. If the current inputs are strong, there's no reason this bull market has to end just because it's the longest, almost coming to be one of the longest bull markets in history. The bull markets don't know time, they know inputs. So if the situation isn't changing, earnings are increasing, revenues are increasing, monetary policy is generous, the stock market should continue to increase. But there's no guarantees of when and how that will change. Okay, so who had a question? Yes?
Just out of curiosity, what's your relative time frame when you say long-term versus short-term in the stock market?
Long-term for me is 10 years. And that's the smallest portion of long-term. Long-term for some people are maybe 20 years. It really looks at your retirement horizon. So if you're recently graduated, like you're recently graduated, you're 22, you have a 50-year work history ahead of you. So you shouldn't care at all what's happening in the stock market right now. Just keep piling $18,000 a year into your 401k and don't look back, because you'll be fine. But if you're going to retire in 10 years, it still don't have to worry about too much, because typically any pullbacks have returned within the 10-year period. But if you're in that 7 to 5 year window of retirement, then it may be prudent to kind of move your money to some safer locations. But long term, I was just looking at one of my best performing stocks was Philip Morris, and amazing return. It's a stock I just bought and I just forgot about, and it was in an IRA, and I'm just like, wow, that did really well, And so, over the long term, you buy great companies that have great products and established histories. You don't really have to worry about these ups and downs of these market turmoil, because great companies will always win out. And it's always been, in the last 70 years, the best investment advice was always to be in stocks as much as you can, because the stock market has always surpassed any of these troubles or declining stock market prices. Now, this lecture isn't advice for your retirement. This isn't what you should do right now. I'm not advising pulling your money out or putting more money in the stock market. This is just a discussion of what's happening and what are some inputs to increasing the stock prices in 2017. So I'm not a financial advisor. I'm not advising you to do anything. This is just a discussion, knowledge-based type of environment. So any other questions? Yes?
One I worry about is I've looked at a few different statistics lately, but the average person or the mean person over 65 in this country has about $60,000. I've heard two numbers: $60,000 in assets, total assets, and I've heard $10,000. But this is terrible.
Yeah.
These people, and this is the average. So there's a lot of people with even less. And the problem is these people never thought about. I was very fortunate when I used to drive into the city years ago. I listened to WOR, and I listened to some old people might remember Bernie Meltzer. He was the Susie Orman of his day, And Bernie told everybody put 10% in, away in savings or whatever. People just, we have to educate young people. I mean, college graduates, they know. You just told them what you should be doing.
I showed Elaine how to make $130 million in her 401k.
Yes, there you go.
And it's a very simple equation. You put your $18,000 in, you get your company match, you keep it 100% invested in stocks, and it could grow. That's at the historical rate, it could grow to that amount.
And how do we, what we have to do is somehow educate other working people
The problem, yeah.
Bernie said the day you start working is the day you put money away.
This is the problem. One problem is we're Americans. We like to spend. We like big things. When I was in Europe, everything was so tiny. The refrigerator, the cars, if you had one. We're big spenders here. We want to have a certain lifestyle. And most people don't, especially of our generations, they didn't save between 22 and 32, or even 22 and 42. It wasn't even a thought of really saving much for retirement. We passed that up. And 401k is a difficult vehicle. Pensions work better. 401k is difficult because you're expecting the employee to be an asset manager, knowledgeable about investments and make their own investment decisions and set their own savings rates. So most people set less than 5% in their 401k. So they didn't listen to Bernie and do the 10%.
Because if you listen to Susie Orman or
right.
Bernie, that would level out our peaks and valleys. Because what would happen is then people are saving, not spending. Okay, so we wouldn't get these bubbles and higher peaks. But then when we go into a recession, since they have savings, they can still pay their mortgage, they can still buy necessities and
right.
so on, and that would, level off the valley also and bring that up. So
that would be a smoothing effect, yes.
And I think it's, we have to do something, the country or whatever, to educate.
We're trying at Stony Brook. I'm just going to take these two questions. We'll get back to you if there's more time. Yeah.
Something you will be happy about is that there are several thousand high schools around the country right now that have education programs specifically for personal finance. And those are just in high schools. And when